Hello and welcome to BQ Prime. You're watching this special interaction on the Indian consumer sector, and joining me today is Kunal Vora, who's the head of India Equity Research at BNP Paribas. Kunal, thank you very much for joining us on BQ Prime. Let me start off with the first thing. Last couple of days and I think couple of weeks, we've seen crude inching up to about 90 and $95 a barrel, and it has a impact on the entire consumer sector. How do you look at the entire scenario of how consumer companies are going to manage this kind of raw material escalation as a result of crude price?
Yeah, hi Sajid. Thanks for having me. Our view on the consumer sector has been a little negative, and this adds to the pain which we are seeing right now. So, if you look at over the last few quarters, the revenue growth for the sector has been coming off. If I look at like longer term, the sector has grown at about 8% in last decade. The growth rate briefly inched up to double digits in the like high inflation period. But as the inflation moderated in the last few quarters, the revenue growth has started coming off. So what you have now is pricing which is fading and volumes which are not really recovering in a big way. And the volumes are not recovering significantly. The reason being that there has been a sizable 30-40% price increase in many categories over the last few quarters, and the reversal has not happened. So what you are seeing now is a fading pricing benefit of weak volumes, which are also partly caused by the rising competition, especially the small players, regional players are making a comeback. And what was countering that was expansion in margins because RM cost had come off. But that tailwind also seems to be going a bit away because crude has started inching up. So crude, which went to about 70 levels, is now back to 95 plus levels. And crude is not the only one. We've also seen some inflation in lab, seen some inflation in palm oil. So RM inflation is like, making a small comeback. It's still not a big worry, but yeah, if this continues, it's something which can become a headwind.
My FMCG reporter tells me that if you look at the ground on the ground, you're seeing a lot of small players coming and uh, taking away pie of the larger players, especially the unbranded players who were sidelined when the prices were going up. And now there's a lot of demand has moved to those unbranded players. Do you also agree to that that there is a revival in the smaller players, small and medium and players who are chipping away the shares uh, from the larger players?
Yeah, that's the normal course of action which we've seen historically also, wherein when the RM cost is inflating, there is very high volatility. These players find it difficult to manage. But what we've seen in the last few quarters is RM cost has come off, and the larger players have not lowered prices. So that really provides some space for smaller regional players to increase the competitive intensity, gain some market share which they might have lost during periods of high inflation. And we've seen that this is something which we highlighted in our last price tracker report. So just a bit about our price tracker report, we track products about like 150 products across about 20 categories, and we look at the monthly prices and what's really happening over a period of time. So what we observed last time was that despite RM prices coming off, we did not really see much of a like adjustment to the prices. And we did expect that competitive intensity will go up. And that's something which was acknowledged during the earnings season by a few companies. When a couple of companies did mention across the FMCG pack that the prices, unorganized competition is making a comeback.
Give me a sense of why companies have not been able to pass through some of the corrections in raw material prices in the last few quarters. Means ideally they should have gone for more volume, because volume have taken a hit because of the higher prices. And because many companies have now moved on to the SKU models of smaller ones, volume has further taken a hit because of that. So why they have not been able to pass through? Is it that they are looking at maintaining margins or at the cost of volumes and market share?
Yeah, so like what we saw during the high inflation time was the margins had taken a hit, gross margins had taken a hit. To an extent, they tried to protect it by lowering advertisement spends. But having said that, the margins had come off. So when the RM cost started moderating, the question was like, what do you like? Do you really pass on the entire benefit to the customers? And the companies have decided that like they also need to recoup some of the lost margins. And thus, what we are seeing in the last few quarters is a significant recovery in gross margin for most companies.
Hmm.
And part of that will get reinvested. Ad spends, they are all talking about raising advertisement spends. But having said that, you are seeing an improvement in gross margins and some improvement in EBITDA margins. But again, it comes at the cost. Like volumes could remain a little weak. You could also see slightly higher competition as a result of this strategy.
Mm-hmm. Uh, what about the SKU sizes? Because we had seen, 5 rupees SKU, then going up to 10. Now we are seeing HUL and others looking and pushing distributors for 20 rupee SKUs. Uh, is that going to help in some way for the companies, consumer companies?
So yeah, we had seen this shrinkflation phenomenon in the like last few quarters, especially during the high inflation time. Having said that, once the prices are taken up, they don't really come down. Like what you could see is some increase in grammages in certain like packs. Having said that, we are seeing more of that happening at the value segment because value segment is where you see higher competition from regional and unorganized players. But on the premium side, we haven't seen any reversals. So in like large categories like soaps, detergents, what we've seen is some changes into prices in the value segment, but we haven't seen that happening in case of the premium. And also where you've seen some price adjustments are categories like which are more linked with commodities like edible oil, like coconut oil, but not really in case of some of the large categories like soaps and detergents, especially in the premium side.
Mm-hmm. Uh, do you still see some pressure building up in the edible oil sides, because we have seen a lot of price cuts happening in that segment compared to others? You still see that there is room for a price cut, or companies may look at further price cuts?
So, like our price tracker indicates that this segment has already seen a large amount of price cuts. Having said that, when we also look at raw material costs have come off even like more. So, what we are seeing is like some margin expansion. It's a category in which making large margins, especially at the value segment, is very difficult. But so like you are like looking at the cost and you will keep on adjusting your pricing accordingly. It's not a segment in which you can make supernormal margins.
Mm-hmm. Uh, it you are underweight on the Indian FMCG sector. Is it only because the valuations are rich, or are there any other reasons why?
Yeah, it's a combination of both valuation as well as growth. What you have is a sector which is growing at maybe 7-8% revenue growth. Even if I look at EBITDA growth, earnings growth, they've been just about like low double digits. So for the kind of growth which the sector offers, we find the valuations to be rich. If I look at the progression over the last decade, the revenue growth in like say period 2011 to 2015, these companies were comfortably growing at mid-teens. Now that seems to be a distant dream. Coming back to double-digit growth seems difficult. We saw that briefly during the period of high inflation. But again, when I look at street estimates in FY 25, 26, market is expecting that these companies will continue to report double-digit revenue growth, about 11, 12%, which we believe will be difficult. Our estimates for most companies are below consensus. We are at like mostly high single digit and not double digits.
Mhm. And that will be primarily driven by price hikes or volume growth, both of them.
So price hikes will be having a very, very limited role from here unless inflation really becomes a bigger issue going forward. Bulk of the heavy lifting will have to be done by the volumes. And we have concerns on volumes because the mass market is not really doing well. You have affluent which are doing well, but mass market is still not doing as well. And with that, driving mid to high single digit volumes will be difficult. And if pricing is not contributing, getting to double digit revenue growth will be a challenge.
That's interesting that the street is expecting that demand may come back from the rural markets or semi-urban markets in the second half of the year. Do you don't foresee that happening?
So volume growth will come back, but finally, what we are looking for is revenue growth, and we believe that that might be a challenge. Inflation is still having an impact. While RM costs have come off, you have vegetable inflation, which is still hurting the masses. If I look at the rural wage growth, that's still in mid-single digits, not really increasing much. If I look at agro-commodity price increases, that's again like mid-single digit. Like it's not the time like in the historically in election years, we've seen much larger MSP increases, but we haven't seen that kind of a large MSP increase. And like there is additional worry which is coming in if the RM costs remain elevated, like crude price starts inching up, that becomes an additional worry. So in the second half, volumes could increase a bit, but not enough to take the revenue growth to double digits, which is what the market is expecting.
Two concerns which one we spoke about is the crude prices which is going up about $95. That could have a cascading effect. The other one is about the monsoon, which again people are talking about that it's not been as per expectation, and that could also have an impact on the rural demand going forward. Are both two? Have you factored in both of these, or is there further downside to what you have penciled in as of now?
Yeah. So historically, if you see how the consensus estimates have moved, not only for consumer, but overall for the Nifty, they typically come down. Wherever you start, you typically end at a lower level.
Hmm.
So these risks, both the like sharp increase in crude price as well as the monsoon, which has been a little weaker. Like you had four consecutive good monsoons, and this year we might end up with a like weaker monsoon. I think the latest data indicates we are about 6% lower compared to long-term average. So these are incremental concerns. Our estimates have been below state even without factoring in these concerns.
Mhm. Give me a sense within the FMCG sector. There is you have the home and personal care, then you have oral care is separate. Then you have you know uh, what do you call uh, the
Food
oil,
business.
edible oil, and other segments which are coming in. Uh, which are the segments which you think may be able to stem all those headwinds and may be able to perform as compared to others?
So growth across consumer staples are not dramatically different. So if I look at longer term trends, like HPC companies might have grown at 8%, maybe food companies have done a percent more, 9 or 10%. But where you can see difference is not within staples, but like see if you look at staples versus discretionary. Whatever categories are being driven by the affluent consumption, which is like really the top 10% of households, those are the ones which are doing well, and they are not really in staples. In staples, you have like food businesses which are doing slightly better compared to HPC, but at the same time, you see much higher growth in discretionary compared to staples right now.
Mm-hmm.
And within discretionary also to add, again we can split into mass discretionary and the affluent really. And like what we are really seeing is the affluent consumption, which is driving consumption right now. And even for FMCG companies which are more aligned to premiumization, they are likely to outperform.
Biscuits also for food and biscuit segments as well. You'll see the same kind of growth, 8 to 9%.
So even in that segment, if I look at near term, there are concerns. This is one segment which the companies have highlighted that unorganized competition is making a comeback. It's also a category in which price hikes have been meaningful. So while our longer term view on the food business remains positive, but the near term concern is that they also have a high base to deal with.
Mm-hmm. Um, I know you have an underweight on the entire FMCG sector, but within the sector, which are the companies that you like?
So without getting into specific names, we like certain companies from the food business. We also like the tobacco space, conglomerates which are operating in tobacco plus FMCG. So we have a few preferences, but again, that's within the sector. But if I look at from a strategy perspective, which is a different other hat which I wear, uh, consumer staples is underweight for me.
Kunal, it was a pleasure talking to you today. Thank you very much for joining us today on BQ Prime.
Thank you, Sajid. Thank you for having me.